Welcome back after the break. Now let's understand the impact of this rate cut on banking and financial sector. And we have with us Rahul Malani from Mirai Asset Share Khan. Rahul, good afternoon and welcome to ET Now. How much impact do you see of this rate cut on the banking and NBFC sector in respect of credit growth and also the net interest margins?
Sure. Good afternoon. Firstly, the outcome is positive for the NBFCs, but of course it has turned a positive surprise has come in for the banks, which we earlier thought that lower repo rate cut would hurt the margins of the banks. But the CRR cut has put some cushion to the margins for the FY26. In the near term for the banks, especially for the banks, in the next few quarters, there will be margin compression, but over the cycle, over a period of 1 year or so, earlier we were taking in 20-25 basis points margin compression over the 100 basis point cut over the cycle. So that would be restricted to around now 10 to 15%, 10 to 15 basis points in case of banks. And for the banks specifically, here more so mid and small size banks would be benefited because they were the banks which were facing due to the liability franchise. They had weak liability franchise and they were facing the cost of high deposit costs due to tight liquidity. So it will be more positive for the small and mid-sized banks, and they might even show some stable NIM trajectory also versus earlier lower trajectory.
That it would be great, good for the mid-small size bank. But how do you see the impact, especially on the NBFCs? Because in NBFCs we normally have a reset cycle which is actually longer than banks. So do you see portfolio shifting from NBFCs to banks and more NIM compression in NBFCs compared to banks?
So basically here we believe that NBFCs and mid and small banks would be quite benefited from this, and we believe that this is a large banks would at least benchmark the market returns, but then for NBFCs and specifically the small finance bank, there will be updates in the earnings because if we look at the two parts from here, loan growth has specifically, we believe that loan growth has broadly bottomed out for the system as a whole at 10%. We believe that loan growth will be around 12 to 13% in the FY26. Secondly, on the margins front also, there will be some support for the banks in terms of CRR cut. Around 5 to 7 basis points overall over a period of in FY26 as a whole if we take. And specifically for NBFCs as per se, we believe that this pass on they already have a high yield, and once they get pass on to once this lower rate pass on to the cost of funding, it will not only help to boost their operating profits.
Okay. Just wanted to understand how will this overall rate cut impact the overall bond portfolio of these banks especially?
So basically it will be because what happens is that in the lower yield regime, when the yields go lower, the investment bond portfolio value increases. So ultimately this will help it will help PSBs, public sector banks in large because they have a large investment books. So in terms of if we talk about in terms of impact of treasury profits, this will help at least PSBs in this.
With this, we let you go on that. Thank you so much for taking the time out and helping us understand what it really means for the banking and the NBFC space. If
you like this video, then like, share and subscribe to ET Now.